Good morning, uh, good morning, good afternoon, good evening to everyone, depending on which part of the world you are. Uh, I'm doing this webinar from Dallas, so it's still Friday here, Friday evening, Friday late night. Uh, so thanks for joining this webinar. And today I'll be talking more about the current situation and what is happening in the market and what the market is telling us. And we'll try to analyze, and especially the Indian markets, correct? We'll try to find out what's happening in the Indian market and where do we go from here. So this is the market update, because a lot of people are saying market is too overheated, market has gone up, we need to book profits, and all kinds of stuff is going on, correct? So before we drill down what exactly is happening, let's look at a big picture, what's happening at a national level. So in India today, COVID cases have still not spiked up, means peaked up. It is still spiking, and the numbers are still going up every day. Information technology and pharma sector has taken off in the Indian financial market and stock market, and of course even the communication sector. But still there is a lot of pain on the main street. There is a lot of pain in small businesses, and people are still feeling the pinch. There is partial lockdown in many parts of the country, and things are still not normal, correct? And people are still not sure what's going to happen in next 3-4 months, and there are tough times, and many sectors are going through a lot of pain. At the same time, Indian financial foreign currency reserves have gone to all-time high, so that's a good. A lot of FDI is coming to India, so that is at a national level. Global level, COVID cases are still spreading. It has not yet picked up. America is also, every day the numbers are going up. Number of people dying is also going up. More than 150,000 people have died in US. It's a large number by any standards. Still there is a lot of pain. International flights have not started. International tourism is dead everywhere in the world as of today. There is a massive stimulus by developed nations. So especially US has pumped in trillions of dollars in the economy, and they have handed over a $1,200 check to every person in US 3 months back, and they're handing over another $1,200 to every person in US in the next 1 month. Plus they're giving $600 per week to any unemployed person, additional money. So there's a lot of money is getting pumped in, and the Fed is printing a lot of dollars and buying bonds and flooding the market with liquidity. At the same time, there's a global supply chain disruptions, correct? The supply chain all over the world has got disrupted because international flights, there is a fight going on between China and US, and nobody's trusting. China has lost a lot of credibility, and there's a lot of things going on, correct? At the global politics level, there is elections in US, so there's a lot of uncertainty. So behind this backdrop, markets are still going up. So people are not, and certain stocks are still doing way high. So people think that markets are overvalued and we should book. I'm not of that. I do not agree with that. So let's try, but I'll give you my reasoning later part of the presentation. Let's understand what exactly is happening in the market, correct? So let's see the facts, let's see the data, correct? So what remember, this is my slide from April 7th, 2000 webinar. This was my first webinar after the COVID came, and that time I said, when the markets had corrected more than almost 40% in 1 month's time, I said the world recovery will start from US stock market, and cloud computing and digital economy will lead, because during this lockdown, the only sector which was allowing people to stay connected and work and make the world function was IT, and healthcare was another sector which was going to solve the problem, because this is a healthcare crisis. This crisis was not man-made crisis. COVID-19 crisis is a healthcare crisis, and this healthcare crisis, when it came, nobody knew how to react. So there was a massive fall in the stock market, and there was a disruption of business worldwide. So officially we are in a recession worldwide. What a recession means, when for 2 quarters GDP numbers give negative growth. So March quarter was the first quarter where there was a negative growth in the GDP. The GDP almost fell by 10% worldwide, and in this quarter the GDP fell by more than 20%. Correct? US, the GDP came down by 32%. Germany, so the GDP has come down for 2 quarters consequently. So we're an official recession, but. So this is one of the sharpest recession the world has seen, and this recession happened because of the health crisis, not because it was not a man-made crisis like 2008 or 1994 in India, or 2001 when technology bubble was there. So this crisis is a health crisis. So the focus everywhere is to solve the health crisis, and if the health crisis is solved, automatically the recession. Now they say in this third quarter, as the world is opened up from July, partially much more than April, this quarter the US GDP is going to go up by 25%. The least estimate is US GDP is going to go up by 25%. I'm sure India is also going to see a growth rate in the GDP this quarter. So officially the recession will end in this quarter. So officially, correct? So this is going to impact on the financial stock market prices, correct? So now let's see how the numbers. So this is, I have updated these numbers. This slide was there in every presentation. So if you see, these are the Nifty, Nasdaq. I'm just showing here S&P 500, Dow Jones, and Nikkei. So now if you look at January, the indices are here. As of March, the market had fallen by 38% in India, 28% in Nasdaq, 34% in S&P, Dow Jones 37%, and from bottom it has recovered. It has recovered by 46% in India. So the Indian market has recovered by 46 from bottom. Nasdaq has 51, S&P 500 by 45, Dow Jones by 45, and now we take the rupee depreciation, which was 5% to dollar and 10% to yen. The Indian stock market, the year-to-date return, if I take year-to-date return, is still minus 9%, but the US has given 24%. So India is underperforming 33% compared to the US market. S&P 500 minus 14, Dow Jones minus 14, and Nikkei minus 13. So India is still a lagging economy in the world recovery because the COVID crisis has cases have not peaked up and not plateaued and started. So we'll see that in the coming quarter. So Indian markets are still underperforming the US and Japan. Now, but they have recovered 46% from the bottom. US has recovered 51%. So Nasdaq is giving a positive return of about 15% for this year, and that is an amazing feat, correct? So now, where do we go from here? So let's analyze the sector wise. So let's do a deep dive. If we do a deep dive and see sector wise, so I'm taking the worst sector first and the best sector the last, correct? So this is, I'm talking about India. So if you take the current major market indexes in India, the Nifty PSU banks is the worst performing sector. 1 year return even today is minus 49. This number is as of yesterday. This presentation I did yesterday, so the number at 12 o'clock in the afternoon I downloaded it, and this is of yesterday, July 31st at 12 p.m. It has gone up 29% from the bottom, 52-week low, but it's still 50% from 52-week high, which was on February 14. So this PSU banks are still the worst performing sector today in India. Then the media, because nobody can buy newspapers and they rely only on television, but television also, IPL games are not happening, so advertisers are not spending that much money. So the media has given minus 34% return. It is, and it's 37% from 52-week high. Then Nifty Bank, this includes PSU banks and private banks, it is minus 26%. And it's still 41% from the 52-week high, a large number. And it has gone in, see, all these worst performing sectors have gone up 20 to 25% from the bottom. Private sector banks is minus 25, but they have gone up 32% from the bottom, but still they are 34% from the peak, like HDFC, Axis, banks I'm talking about. Then Nifty public sector enterprises. This includes HPCLOs, Oil India, means all other BHEL, Nalco, all those companies. It is 27 minus 27. Okay, this should be percentage, not and. Minus from 52 low, it is 23%, and this should be minus 28. It is given negative 28 from 52-week high. Nifty Metal is minus 17, but it has gone up 45% from the bottom, which is big number, but still 27% high from all-time high. So what we are seeing is Nifty Financial Services. This includes insurance, NBFCs. This includes HDFC, AMC, and Nippon AMC, mutual fund companies, life insurance, and NBFCs. They have also given minus 16 and minus 27 from 52-week high. So these are the, mostly if you see the financial services and PSUs, they are underperforming, and manufacturing sectors, they are underperforming the indices, and they are way, so let's see, there are 10 friends and they all fall in the well. So everyone can't come out of the well at the one go. There is one person will take the lead to come out of the well, and he'll help pulling everyone else. The same thing has happened in the indices. All these 11 sectors, they went down. Everyone went down together with COVID-19, and some sectors started pulling up. So who started pulling up? IT was the first one to pull them up. But I'll share that number later on in this presentation. Small cap is minus 10. It's still 23% from the bottom. Nifty Commodities minus 8, still minus 15% from 52-week high, 1 year return, correct? But Dow Jones is only minus 1. Nifty Energy is minus 6. Now this is, Nifty Energy includes Reliance. So if you remove Reliance, this will be minus 30%. So if you remove Reliance, it will be minus 30. Reliance has got a lot of weight, and Reliance is not a pure energy company. Reliance is also a telecommunication company now, and also retail in business. So this Nifty need to change that, correct? But minus 7% here. Now Nifty has given 0% return, so it has recovered fully in last, whatever the fall it was because of COVID, and it has gone up 48% from the bottom. Big number, correct? Big number, but it's still 11% away from 52-week high. Nifty Auto has given 6% positive return, because two-wheelers, as I remember 2-3 weeks back, in one of my webinars I said, two-wheelers among the automobile sector will be the first to recover, because people will avoid using public transport, and they like to. So in US, car manufacturers are doing well. The inventories have gone down, and in India, two-wheelers will be the first to recover. Up move from bottom 63%. If you see here 60, so in the previous slide I showed you the banking and financial, they moved 25% from the bottom. Now you see a 45, 50, 60 them, and 14% from 52-week high. Now doesn't this make sense how the way the economy is recovering? So if you see FMCG, Nestle, Hindustan Lever, in fact they didn't fall down much. They didn't, in this fall, in March, February, they didn't fall. They are giving 7% return. They have 15% from the bottom because it didn't fall down much, and they're still 5% away from 52-week high. Nifty Consumption, 11% return. Nifty MNC. So MNC companies are companies which are with low debts, correct, and very good management and very solid balance sheets. So they are giving plus 12% return. 41% from the bottom, and they are 5% away from the 52-week high. Nifty IT, 17% return year over year, 66% from the bottom, and they are at all-time high just now. So they are at 52-week high. Nasdaq, 31% from bottom, 60% from bottom, minus 2%. So it will again breach 52-week high in a day or two. Pharma, 38% return, highest of all the sectors. This is Indian pharmaceutical, 76% from the bottom. Now, in fact, this does not include additional 2 to 3% gain which was there yesterday. So basically pharma is given 40% return from the bottom, and it's at 52-week high. Why pharma is doing so well? Because pharma is the sector which is going to pull up everyone from this COVID crisis. That's why pharma, and also, so this doesn't it make sense? Also, what has happened is pharma, The US doesn't trust China anymore. India was 17%, has a 17% to 18% share in the global exports. China has 22%. China is a bigger exporter than India, but US no longer trusts China, Western countries, so they are more, everybody wants more from India. So Indian pharmaceutical companies are doing exceedingly well, and the rally, I think the rally has just started. It's not yet picked up. It'll take some time, because imagine 8 billion vaccines they have to produce to give every person in the world, and it's not an easy job. So a lot of outsourcing is going to happen to India. Other than vaccines, there will be a lot of other medicines, and so there is a lot of change happening, correct? So if you see, if you look at the way the world is functioning economy, this indices make sense. So I don't think the market is overvalued. You will see corrections. You will see some companies which have very poor balance sheet and poor management going under, but that doesn't mean the market should not go up, because the strong players are going to be stronger, and the big companies and healthy sectors are going to be used more to pull up the whole world out of this health crisis. It's a health crisis, so there is going to be more spending by everyone to recover. So I think you will see a minor correction, but you won't see a major correction. That's what when I analyze these numbers, I get that. Now look at this. This is the India picture I showed you. Now let's look at the picture. Is the same story getting played in US? Is the same story getting played? So I downloaded as of yesterday, July 30th. This is the actual data I have downloaded from Fidelity. So I have account with Fidelity Investments, and I downloaded the data sector-wise. So communication services has given 11% return, which makes sense, correct? Because everybody works from home, and this consumer discretionary 16%, consumer staples 3%. Ignore this. This is of yesterday. Just focus on 1 year, correct? Energy minus 40. Didn't I say in India energy was showing minus 6 because of Reliance? But if you remove Reliance from them, energy in India also will be minus 30, 35. So energy minus 40. Financials minus 15. Like US, in India, financials are giving minus 25. The US banks are this time much more stronger than Indian banks. Indian banks were already going through a recession for last 3-4 years, and COVID crisis has created more problem for them. US was not going through recession. US is in growth path, and the banks were doing well, but COVID has put a dent on them. So they have come down by 15% down. Indian financial private banks have come down by more than 25%. Healthcare 15%, industrials, manufacturing company minus 8, IT, again here IT is 30%. Materials 2%, real estate minus 2%, and utilities. There is no recession on real estate in US like the recession of real estate in India. Information tech. Now, if you go and zoom down this further, correct? If you zoom, so the same trend you see in US, it makes sense, correct? That this crisis is going to be solved by healthcare and pharmaceuticals and IT. Now, you take IT, correct? Within IT, so if I break the IT sectors, there are again 6 kind of industries: communication equipments, electronic equipments, IT services, semiconductor, that is chips, correct? Software and technology hardware storage. So see, the highest return technology hardware storage and peripherals. For cloud computing, the hardware is required. 72% return. Software 37% return, like Indian IT companies, correct? Services, Microsoft comes here in this category. And semiconductors, correct? AMD and all those chips, they come under this 29% return. You saw this? So this, I'll give you another example. 40% of the world's workforce do office job. I'm talking about organized labor. I'm not talking about the unorganized labor or this in India. I'm talking about organized labor in America. Of all the jobs, 40% people work from office, 60% people they have to do hands-on jobs. So if you're working in Starbucks, you're working on, you're driving a truck, or you're driving a train, or you're a pilot, those are hands-on job. Those who have an office job, proper desk job, 40% people in America have that. Now, of that 40% people, only 0.5% people were working from home before COVID crisis, and that was basically because of some domestic personal reasons people were working from home. But with COVID crisis, working from home has become 80% of this 40% jobs. So 80% of those 40% jobs are working from home, and that is going to continue. They say 50% of workforce will never come back to work in office now. They will work from home, and this has created massive demand for IT services. Imagine massive demand for internet, massive demand for laptops, massive demand from, and the companies are enjoying. They really are seeing the benefit of work from home. See, when you are working from office, it becomes the prerogative of the management to prove that the person is not working properly. But when you are working from home, it becomes the person's responsibility to prove that he's adding value. It's not the management. So they are seeing the benefits of working from home, and it has cut a lot of costs, traveling costs. I'll give you another example. IBM spends, even Infosys, correct? IBM, but I'm giving you an example of IBM. They spend $1 billion every 2 weeks on travel. So they spend $26 billion in travel budgets. All that cost has come down to practically zero, correct? So imagine the savings, and they are all there doing the work on Zoom meetings and webinars like what we are doing today. So it has cut those costs. It has cut down the rental costs. So many costs. So all these IT companies are benefiting. So now take, for example, Infosys, TCS. They are benefiting. They are able to negotiate their salaries better with their employees. Their revenue, the demand for their services have gone up. So their pricing power has gone up, and their overheads have gone down. Office rental, everything has gone down, correct? That transportation cost to bring people from home to work, everything has gone down. So their IT services is benefiting the most, and their profit is going up. Now, second sector is biotech, correct? Healthcare. Within healthcare, biotech has given 35% return. And in India, there are very few innovative biotech companies, but most of the biotechnology, US is the leader in the world, and they have done very well. Genomatics, correct? Pharmaceuticals in America has given only 8% return. Indian pharmaceuticals have given very high return, correct? 40% return. So look at this. These two sectors are also leading in America. They are also leading in India, and this will continue. This will continue. The general thinking that everything goes up when market goes up is not going to happen. It's not going to happen. So let's say now in the banking, so you take in US banks, correct? Minus 15%, banks are minus 26%. Capital markets are positive because everybody is investing in stock market and staying at home. More and more retail investors are coming. Consumer finance minus 31 and insurance minus 15. So you see, except for capital market, in financial services, everything is down. Same trend like India, correct? Same trend like India. Consumer discretionary, if you see consumer discretionary, there are two. Internet, direct marketing, Amazon comes here, 50% return, correct? But automobile minus 34% return, and diversified consumer services minus 46% return. But so even it's not going to be one-way boom now. It's going to be very selective. It's going to be theme-based. So every sector is going to play a different role. And this COVID-19 was such a major event after 100 years. Most of the recessions are man-made, correct? This recession was nature. So this has come after 100 years. So this generation has never seen this kind of recession, and they are going to have to cope up with. So you have to be very careful. Everything is not going to go up. Selectively, sectors are going to go up. So theme-based investment is going to gain more popularity. And as theme-based investments are gaining more popularity, retail investors find difficult to do it. They randomly follow tip-based investing, which is disastrous. And they do emotional investing, and when that happens, you get negative returns. So if you invest in generic funds like large cap, mid cap, small cap, hybrid, balanced funds, you are getting negative returns because they are generic funds, and it's not a theme base. It's not focused on sectors which are going to go up. That's the problem which you are facing, and that's the reason the inflows in stock market, mutual fund industry has come down. SIPs also has come down, correct? And people are thinking the markets are too high. I don't think so. Markets are going to go up systematically, and the sectors which are leading this recovery are going to go way up than what they are today. So even if you look at now, I talked about sectors. Now let's talk about stocks, correct? Some of the stocks which have gone up from the Indian Nifty. So if you see again Indian Nifty, Reliance has gone up because of telecommunication, 39%. Dr. Reddy, 65% return. How many of you have even heard Dr. Reddy's name on television every day? It's in news. Nobody, correct? Very few people. TCS has given 6% return. Infosys 24% return. Hindustan Lever 14. So all these companies are mostly cash rich, no debt on the balance sheet. Reliance has, but it's paying off the debts. All these companies are zero debt companies, and so I'll see other anomaly, correct? Many people say, okay, I don't want to invest in equity mutual funds or stocks because they are volatile. Okay, so now if you're investing in equity mutual funds, you're investing in companies like Hindustan Lever, TCS, Infosys, because mutual fund invests in those kind of companies. But if you're not investing in equity mutual funds, you're investing in debt funds or you're investing in bank deposits. So eventually the money has to go somewhere. For use, correct? The capital has to be used. So if you're investing in equity, the capital is used by this blue chip company, which has zero debt company. They have no debt. They never borrow money. But if you invest in debt funds or fixed deposit, money goes to whom? Money goes to Praj Industries, GKW, correct? Money goes to Finolex. Money goes to Jain Irrigation. So they are the companies where you don't want to give them loans, but they are taking money goes to builders, Lora builders. Money goes to those kind of realty companies, and which are so when you're investing in debt, you're investing in mutual fund. Money is not going to the best asset class. Money is going to B class, but that people are going to take some time to understand that. So according to me, today the best asset class for investments is the equity market, where and as the interest rates come down, you'll see more and more pressure on bank deposits. Now these are the top 10 gainers in last 1 year, correct? From the Nifty. See the market cap they have created. See the billions of dollars they have added to the wealth of everyone in India. Now the current, but unfortunately, what we are seeing in the market, at Simplicity we are not doing that. At Simplicity we are investing only theme based. As many of you who are attending this webinar know that we try to build a story in your portfolio. If every investment has got some story behind it and it's interconnected. But when you do invest randomly, most of the 99.9% people in India invest randomly. The portfolios, and they don't follow a process. There's no logic. There's only emotion behind it to get the highest return. And they think whatever is the hype in the TV or Economic Times or friend advice or on WhatsApp group tips they get. We never do tip-based investing. And those of you who know me for last 40 years, I have never ever talked to any broker or asked anyone what is the tip going in the market, and never do insider based or tip based. It's like, you're building your life based on astrologer's tips. As you are every day, for every activity you go to astrologer, what do you think I should do? Insider investments, you never do that. You'll always lose money. I never do that market gossip wise investing. So every investment portfolio should have a theme and not a random collection, because I still feel the markets are going to go up, but everyone is not going to make money. 90% people are not going to make money because they'll be random investors. So average GDP of India is $1,800 per capita, but people who are watching this webinar, their GDP per capita income is more than $10, $15, $25, $30,000 or even $100,000 a year, correct? So if you're in the top 2% of the population, so if you want to stand out from the average, don't invest the way everybody's investing. If you do that, if you do the investing like everybody is investing, you'll get a national average, and national average is going to be negative. The returns, markets are not going to everything is not going to perform. Only selective sectors, selective companies are going to perform. Large companies are going to perform. And themes, you need to invest in the best companies of the world, like Microsoft, Google, TCS of the world, and those theme-based investments you should do. So your core investment should be news. So this is the way you build a theme-based portfolio, correct? So go for US technology companies, go for innovation companies, and go for global multinational. Go so base, and instead of doing random stock picking, I would go with thematic funds, build the funds and build the mutual. So you take away the risk for the company selection also. Do that. So with this is my last slide information, and then I'll take questions. I would appreciate people asking questions on the text box, and also I would like you to, if you like this webinar, to subscribe to our channel. At the end of, you can go on the YouTube channel and click on that bell. But I'll do this webinars once in a month or twice in a month. Coming to upcoming trends, information technology sector is still going to lead the market. Pharma and healthcare sector is going to see further consolidation. MNC companies will increase market share and buy out weak players. So these two sectors have already rallied, correct? They are going to continue. Now is the turn going to be of even this sector. MNC has just started to rally much. In next 3-4 months, you will see a massive rally there too. Large Indian companies will become larger and stronger. They'll attract more FDI, more global investments. We'll see. Let's see why everyone invested. All big companies in the world, Microsoft, Google, they invested in Reliance, correct? Facebook. Same way, you will see other Indian companies attracting more big investments. So large companies will become larger. You will see a gradual change in the financial and investment products in India. Unfortunately, see, I've been used to. Since I live in US, I've been used to investing on theme-based investing for last 25 years, and there are more than 2,000 thematic funds in the US. In India, there are hardly 10 funds. Now that is going to change. There are more generic funds in India. Those generic funds are not going to do well. And people randomly sell any products, correct, there. So, and there are hardly a few stocks which are performing, which is going to continue. The same trend is going to continue, and it's very difficult. And Indians are used to over diversification. In India, people like to have a bail in everything. In investment, they like a bail, correct? They want everything to mix in that. Portfolios don't work that way. Portfolios have to be concentrated with high convictions. So that requires knowledge. So you'll see over-diversified portfolio will give less returns. You will see the pain in the capital market. And so what happens when only a few stocks go up and few themes work out? Everyone keeps on shouting that markets are unrealistic. They will come down. This can't happen. Only 10 stocks perform, and 4,500 stocks don't perform, and they have a bearish tone. This kind of trend is going to continue for another 2 years. You won't see. So the conclusion is markets are punishing sectors with high debts. So companies which have poor management, high debts, and who done random expansion without understanding the global economy, they are punishing them. Do not invest randomly or over-diversify. The more you diversify, the less return you are going to get. Invest with conviction, take knowledge, do deep dive. Don't randomly do some Google search, read some articles here and there. Don't do that. You'll get hurt. Invest with a plan and a strategy. Always invest when you think, okay, if I'm investing today, what happens if market goes down by 5%, 10%? How are you going to react? People never assume how they're going to react when markets go down, how they're going to react when markets go up. Your behavior plays a very important role. Listen to the market. Don't try to pass judgment on the market. See, we are very small people. Even though I'm 40 years in this field, still every day I think I don't know anything. And I try to understand what is market telling me, where I'm going wrong. I try to understand and learn every day. So even after being 40 years in this field, unless you have the same approach, I have seen many youngsters, many things, they just know a little bit and they start passing judgment and calls. And they think market is overvalued, undervalued. They think this is going to happen, that is going to happen. And they talk with authority. and it comes on flat on their face after some time, correct? So average investor is going to find difficult to make money from equity market unless he has a theme and a story behind it. So with this, I end my webinar, and feel free to ask questions, and I'll answer them in the order they are coming. I appreciate it. Thank you for your time. So far, no questions. Okay, so let me also, so on the political front, what is happening on the, what do you call, US politics, correct? So there is an election in US, elections in US, and there as of today, it looks like President Trump is going to lose, and there is going to be change in guard here. So that will create a little bit volatility in the markets here, and that will be a good opportunity to invest in US. Everybody needs to have a little bit investments in US, at least 15 to 20%. So that will give you a very good opportunity when this kind of volatility comes. You'll see a little bit volatility as the election comes closer. Okay, I have a question. Do you anticipate major correction in the markets as earnings have still not recovered and there is a huge uncertainty? Okay, so earnings, so far, the earnings, correct? So market had gone down, anticipating that this last 2 quarters are going to be bad, and that anticipation, the markets came down and priced in the very bad scenarios. The earnings results which have come so far in US, 80% of companies have declared better earnings than what market was expecting, and they beat earnings by 13%. On an average in the past, those companies used to beat earnings by 3%. So the big companies like Google, Apple, Microsoft, they all come with fantastic results. And even some of the manufacturing companies, which way they came with the better results, better than what market was expecting. Now the same trend you will see in India partially. So yes, we all know the earnings are going to be bad, the economy is bad. Now take for this example, this third quarter is going to be, okay, so the first quarter was bad, second quarter was even worse, correct? Because the maximum period of lockdown was there from April to June. So those results have come. Now July to September is a quarter where most of the things are opening up. So July to September quarter earning, market always works on future, not on past. The past earnings is already factored in the price. It's going to be the future, correct? So the future, July to September, as how economy opens up, which every company is going to do more business than last quarter. I'll give you another example. If you inventories, worldwide inventories level have gone down today because factories were not working. So there is a demand. A lot of pent-up demand, and inventories have gone down. So as economy opens up, the problem of demand is not there, the problem of supply chain is there. So the companies which are able to ramp up more production and meet the demands are going to do well. I don't think there is going to be a major correction. There are going to be minor corrections, and there will be stock-specific correction. I don't see a 10 or 15% correction like it happened or 20% correction happened in March. Forget that. That's not going to happen. Now, the second question I have, the run-up on the Indian IT sector. Shall we buy more or sell or take partial profits? Okay, so on talking about partial profits, correct? So let's say you are a captain of a cricket team. You're captain of a cricket team, and your one player is performing very well. So are you going to make him sit in the next match and take a new player? You said, okay, in last 3 matches he had a century, so this match he may not hit century. Let me try a new player. No, you're going to continue with them. So I don't think booking partial profit is a good idea now in IT. They are performing sector, and that sector is going to lead more. Those who have underexposure in IT need to increase exposure. I'll tell you, overall, I find in India, people have very little exposure to IT. So IT has a lot of steam to go. Now in IT also is a knowledge-based industry. So instead of buying stocks, you buy a theme, IT, 100% IT stock mutual fund. You will do very well. you'll do very well. So don't try to play the stock market, and make sure that you have enough exposure to IT. If you don't have, how is gold at this level? Okay, very good. Gold is the flavor of the season just now. Everybody talks about gold. At this level, I don't. Gold was very good in February, March when it was $1,450 an ounce. Today it is almost 2,000. I wouldn't touch gold. Gold is not a productive asset. Gold by itself doesn't produce anything, doesn't create any economic activity. Gold is only for jewelry. Now, as the prices of gold has gone up, the jewelry demand in India has fallen down by 75%. If I read the report yesterday that the Indian jewelry demand has fallen by 75%. So gold just now everybody is holding because they are thinking that dollar as a reserve currency is going to fall. That is not going to happen. Dollar is going to continue to dominate the market. That's my call. That's my reading. Eventually all these people, hedge funds and who have bought gold, they'll sell gold. So I think gold will peak somewhere in next 2-3 months. I would stay away from gold. I wouldn't buy gold at this price. Now, so the three themes that are all good as IT, pharma, biotech, FMCG. You have any difference of opinion? No, I don't have. So IT, pharma, biotech, consumption stocks plus MNC stocks. These are the companies, these are the sectors which are going to do well. So I will continue investing them. And as those who are working with Simplicity and we are advising, you know how heavy we are in this. We have been bullish on these sectors for last 3 years, and we have been at Simplicity, we invest only on theme based. We do not invest generic, and we follow a process. So you know how we are being, and we have full conviction that these sectors will do well. Your view on the impact of US immigration policy on Indian IT. Okay, very good question. Very good question, I'm saying. So because of US immigration policy, this is temporary. After the elections, US immigration will again open up because US needs professionals, and India is, see, Indians don't cheat, Indians don't spy. Like there is a massive mistrust with Chinese working in US, and Chinese students, you know, embassy in Houston got closed, and the corporate America doesn't trust them. So they prefer Indians, and after these elections are over, you will see a change in, even if Trump gets elected, he'll change his tune. No matter who comes in the White House, the tune will change. But having said that, there will be more demand for IT services in India. So I was talking to one of the corporate executives in US, and I asked him, how's the work from home going on? So he said, Mr. Shah, it's funny, you know, we have 6,000 employees, and most of the employees who are manager and above, analyst and above level had laptops. But the problems who are working in a corporate office were accounts payable, accounts receivable, customer service. Those people didn't have laptops, and they had desktops, and they were working from office. Now we had to buy laptops for them and train them how to work from home. And when we did that, we realized if this accounts payable, accounts receivable processes can be further digitalized, why the hell I require them to work from home from US? I can shift those jobs to India. I already have a division in India. So all those kind of, so there is more jobs coming to India. More jobs will come to India, and there will be more demand for IT professionals in India. Of course, after November elections, you will see demand for Indian coming to US also will come back. This is a temporary thing. So the US immigration policy is an election issue, temporary. It's going to go away because US companies need programmers, they need engineers, they need this. And Indians, they trust Indians. Indians don't cheat. Indians don't spy. Indians don't copy technology and sell them in the other countries. Indians don't do that. So that they very well know. So they are going to do well. Compared to the stimulus, the next question, compared to the stimulus by US Fed, RBI and Indian government has provided less. How will it play to bring back the market at pre-COVID level? Very good question. See, India is a developing nation. America is a developed nation. You cannot compare India with America. Now, US has a dollar currency, which is a global currency. India doesn't have a global currency, and now India benefited in this COVID thing because the oil imports came down. Other thing which also happened is a lot of FDI came, so the macros, then even our imports from China came down drastically because of the border clashes, correct? So we had the first time the surplus, so a lot of cash the government of India got it. So at a macro level, the balance sheet is good. Now government doesn't trust the local governments and the state governments where to spend, and that's why it's careful in distributing that cash, correct? And we all understand that Indian government can't do what the US government did. So India, the recovery will be more gradual and more painful than in US. In US, they can afford. What US has taken a chance that my economy, US economy is $22 trillion, and if I don't earn for 6 months and I spend that money for 6 months and recover in next 12 years, what's wrong in that? So their 6 months income is $11 trillion. That's 4 times of India's GDP, and they're pumping that much money in the economy. They can afford to do that. India doesn't have that kind of luxury. Indian recovery will be gradual and more painful, and that's why I'm saying while investing in India, you have to be very careful and you have to go to theme-based investing. Nifty is adding quality stocks like HDFC Life, SBI Card Life. Nifty will get synergy from that as well. Question: which stocks will get removed from Nifty? Okay, so again a good question. More manufacturing stock or more metal stocks will go out. So Dow Jones, they call it in America, they call it Dow Jones Industrials, and Nasdaq is more IT related, correct? So in India, Sensex and Nifty is there. So we'll see a transformation of Nifty a little bit, but still some manufacturing stocks like Tata Steel. I don't know. I'm just making a guess. They may go out, correct? Even companies like L&T or Tata Motors. Tata Motors, I doubt it because Tata Motors is a global player. Jaguar and Land Rover, even Tisco is a global player. But you may see some of those stocks under pressure. Since Nifty, since high volatility is expected, should we also have short-term strategy, 1 year, 2 years, and look to? No. Again, I'm saying you should. 90% of your investment should be your core investments. You should not flirt, correct? So when we all wanted to get married, marriage is a long-term solution, correct? Not a short-term. So same thing in investments. Do go for a long-term. Don't flirt. You'll get hurt more. And you will sell good stocks and buy bad stocks. Normally, I've seen we deal with so many clients, and I see clients are very emotional, and what happens is they always hold on to loss making and sell profit making, and that's the worst part of the thing. So it's like you're dropping a performing player, you're dropping Kohli and getting somebody else, and they call it profit booking. It's not a good strategy. You should have a core reason why you are buying and why selling. Don't trade. The more you trade in, so anybody who traded in 2009 in stock market, he lost the biggest opportunity, correct? So 2020 is 2009 again. So if anybody is going to trade in this market, he's going to be a loser. So you need to invest and just forget it for a long term. Short-term, the next question I have, short-term strategy for short-term investments, substitute for FDs. The substitute for FDs is only good debt funds which are investing in not high-yield bonds, but which are investing in PSU bonds or arbitrage funds or safe investments. I would rather take 1% less return on my FDs and this thing, but go for quality. I would never investment in so recently one of my clients asked me, should we invest in Sri Lanka fixed deposits? I said, please don't touch it. It's a transport company. I would never buy that stocks. Why the hell I would invest in those kind of companies. You remember CRB Capital, you remember Sahara, which used to sponsor Indian cricket team. What happened to those companies? Please do not go for 1% or 2% finding yield. At the most, you should invest in PSU banking funds or arbitrage funds or a good corporate fund, and nothing beyond that. Don't take risk. Go for quality. And then next question is, should we add debt funds for hedging? Which are the best debt funds? Yeah. So I don't talk any specific funds in this webinar. As I said, you invest in PSU banking fund, you invest in arbitrage fund, you invest in good corporate bond fund for a long term, and stagger it, correct? It's not a bad idea. But if you're 28, 30 years old and you're young, 40 years old, and your retirement is still 30 years back, I wouldn't invest in those kind of funds. I invest in pure equity. So it depends on the age profile of the person. So next question is, Indian pharma has to worry about disturbed supply chain from China, which could dampen growth projection. Your view, please. Okay, I don't know very specific cases of specific. This is a high-level question. Yeah, there are going to be problems in every sector, correct? Even in IT, there are problems with chips, correct? So 5G technology. So all these problems will get sorted out. Governments are capable. See, governments can make massive investments. Like US government is making billions of dollars in investments for finding COVID vaccine. So they are giving $1 billion to pharma companies to create COVID, because they have a stake. Because if economy doesn't do well, they don't get taxes. They don't get taxes, they can't run the government. Same thing is going to happen. Instead of going for war with China, where you spend billions of it, I would spend that money in creating a good investment. See, like Maruti Suzuki in India was created by government. It was a 50% partnership of government of India with Suzuki. Indira Gandhi started in the 1970s, correct? Sanjay Gandhi time. So same thing, the government will come with innovative solutions. I'm sure Indian government has some visionary bureaucrats, and they are good thinkers. We'll find that solution. They know. So what do you think? Next question is the final question. What do you think of Apple made from stock split? Yeah, Apple is a good stock, and you continue need to invest in that. And but again, I'm saying I'm not giving stock specific recommendations. Apple is you need to buy that technology sector and stay invested in that. Having said that, Apple is a good stock to hold on, because it's grabbing market share, and 90% of smartphone profits only Apple takes, though they have only 20% market share. It's one of the best company in the world, which has changed the way we communicate, the way we talk, or the way we do web search, correct? It's a very good company. You stay invested in that. Thank you very much. With this, I end my today's webinar. If you like this event, please subscribe to my channel, Simplicity Investing Global channel, and we'll keep you bringing market updates and more information on what's happening in the financial markets globally. Thank you. Take care, and appreciate you attending this webinar. And if you like it, this webinar is going to be on YouTube channel posted. Even you can watch it later again, or share it with your friends. Share the link, because we want to make this financial education more popular and help people. So do share our link with your friends and family members. Thank you very much.